So welcome everybody to today's presentation. It's the follow-up to the bookkeeping, the first part of bookkeeping that was last week. So this is bookkeeping 2 and next week will be bookkeeping 3. Just a couple of things. If you wanted to keep your mics on mute just while the presentation is going on, and then feel free to unmute yourself. You could ask any questions and we'll get those answered. And if we don't have or are unsure of it, we'll definitely find out the information and get it back to you. So I just want to welcome back my coworker, Linda Farmer, who is the Building Bridges business counselor here in Thunder Bay.
Good morning, everybody. Welcome. Ladies, I'm going to share this with you. I am not a bookkeeper. So if you have any questions or concerns, please leave them in the chat. If Lori and I can't answer those questions, we will, as she said, we'll definitely get someone to answer them and we'll get that information back to you. So if you leave the question with your email address that if we can't answer that particular question, if you leave us an email address, we'll definitely get back to you. We'll go to our accountant in the office. And thank you for your patience and understanding. Okay, ladies. So this is, let's start. So for those of you who were here, and bear with me because I'm reading, I have printed out the slides, so I'll be reading them off my table here. So we already did the bookkeeping 1. So this is just a quick review. So there's your record keeping review, your bookkeeping part 1 review, and then we're going to get into bookkeeping part 2. So you know the importance of maintaining up-to-date accounting records and files. Obviously, your purchase transactions, accounts payable, your sales and your income transactions, your accounts receivable, your payroll records, your HST records and remittances, your bank statements, canceled checks, and you're posting accounts payable and accounts receivable into the appropriate code of accounts. And I tend to go pretty fast. If I'm going fast, please just tell me to slow down. So your bookkeeping part 1 in review. So you're maintaining accurate bookkeeping records, which allows you to always know who owes you money, very important, and who you owe money to, obviously, also very important. So the causes of recurring business difficulty and failure include inadequate planning, poor financial management, judgment, and decisions. So it's really, really important to do your daily bookkeeping, weekly bookkeeping, your accounts payable journals, your accounts receivables, because it keeps you organized and it basically puts you in a really good position to understand what's going on in your business. So successful business owners understand their business information and make comparisons from month to month and year to year. Bookkeeping helps you budget. This is why it's important, and it helps obviously with tax preparation, which is really important. So again, reviewing your daily, your monthly, and yearly bookkeeping tasks, your cash receipts journal, your cash payments journal, check payments journal, and your bank reconciliation. So you are opening a new business. Okay, now we're starting bookkeeping 2. Your business types. You're opening a new business. What will be its purpose? Service, sales, or manufacturing. Why does this matter? This is one important factor in deciding which type of accounting systems, processes, and methods to use. Okay, your service businesses. Oops, I got to keep moving my slides. So it sells services, has little or no inventory. Your costs include overhead, labor, and supplies. So some examples of service businesses include companies engaged in transport, food service, distribution, retail, and other industries that sell services rather than products. Your sales businesses buy and resell products, deal with finished goods, costs in inventory. Inventory accounting methods will track inventory in stock. So market-oriented and sales-oriented. Excuse me for 1 second, ladies. I'm a little bit of a cold. So your manufacturing production businesses makes or produces products. Fast-moving consumer goods, food, textile, machinery, and electronic equipments are some examples. Costs are in materials, supplies, labor, and overhead. Inventory accounting methods will track raw materials, work in progress, and finished goods. Defining what type of category your business fits into determines what year-end accounting information you need to capture, i.e. inventory, work in progress, finished goods. So organizing your information, your assets or your business properties. So they're tangible, you can see them, you can touch them. Vehicles, equipment, computer equipment, buildings, communication equipment. Your intangible, your money owing from customers, cars, houses, boats, furniture, TVs, and appliances. Your cash accounts receivable, inventory, and equipment. Those are your assets. Your liabilities. Claims by creditors, money the business owes, the purchase of supplies or services and charged. Accounts payable, loans, mortgages. So liabilities are everything a business owes now and in the future. So your owner's equity or owner's capital, the owner's right to the property, the assets, what the business owes the owner, owner's contribution, less withdrawals or drawing, net profit, loss. So most common forms of equity reserves are simply profit that you are keeping in the business. The equity account shows how much of the company's assets are owned by the owners instead of creditors. If anybody wants to jump in and add anything, please feel free. Your owner's investments increase your equity, your capital. Your additional money, dollars or property owner contributes added to business purse. Your owner's drawing withdrawals decrease equity capital. Owner removes for personal use. So placed on a temporary drawing account, reducing the owner's equity, goods are withdrawn from the business, reducing the inventory. So the accounting equation is assets equals liabilities plus owner's equity, means the total assets of the business are always equal to the total liabilities plus equity of the business. Your revenues and your expenses. Revenues, income, increase the owner's equity, gross. You're selling services and products. Your rental income, interest income. Your expenses, your costs, decrease the owner's equity, cost of goods, services, supplies, and the cost of doing business. So for example, for better examples, your assets are the cash, accounts receivable, equipment, land, buildings, etc., that help the business generate revenue. Your liabilities, the amounts owed to others. Net worth, the difference between assets and liabilities. Your revenue, earning of the business, money coming in. Your expenses, cost of the business, money going out. Okay, so there's a chart of accounts. Sorry, I'm running through this pretty fast, aren't I? Anybody have any questions so far?
I have a quick question.
Go for it.
LA speaking. So when money comes into a business, how, maybe this is not the best question, but how do you allocate it first? Do you put it towards expenses for the business and then you do owner's draw? Like, how do you determine when you've made a sale, where it goes?
That will come in as your accounts receivable, right? Okay, yeah, so your accounts payable are going to be any money that you're paying out to, if you're purchasing inventory, et cetera. Your accounts receivable is money coming into your business that it's a profit for you.
Okay. Thank you.
You're welcome, Ally. Okay, so anybody else? Any questions, anybody? Okay. So here's a list of the chart of accounts. So your assets talks about your cash, your checking, your savings, bank account, accounts receivable, your automobile, equipment, building, land, supplies, accumulated depreciation. Your liabilities are your accounts payable, your salaries, payable EI, CPP, WSIB for staff, obviously, your federal and provincial tax payable. Equity is your retained earnings, your current earnings. Revenue are your sales, your services income, interest earnings, and miscellaneous income. Your expenses are your advertising and promotion, your licenses, your membership fees, your insurance, office expenses and supplies, and your workshop supplies, telephone, etc. Okay. So this is when it all comes together. So this is your income statement. The year ending January, okay. Your revenue, your services revenue, which is 15,000, and then your expenses. So your rent, your salaries, your supplies, your expense, depreciation expenses, and your travel. So obviously your gross income less your expenses gives you your net income. And then it all comes together. Your assets, your cash, your accounts receivable, and your equipment. So your total assets are 12,063. So your liabilities is your bank loan, your accounts payable, your total liabilities is 4,000. So your equity, your owner's contribution, your net income, and your total equity, total liabilities and equity. So it's 4,000 plus the 8,063 balances you to the 12,063. And that went really fast, ladies. That's the end of the presentation.